Good morning. Just half an hour to the open here in Hong Kong, Shanghai and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up about nearly about 0.7%. A couple of things to note. OECD reduction to growth forecast. The FOMC is beginning its two-day policy meeting. And of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes. Really, which is the amount it takes really to do the same here as far as your gas guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong. Up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past two sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying, so this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage wage, protecting people's rights to paid leave. And that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime. And the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that their response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, as to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms, basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well, coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policy-making body is concerned, right? So neither the action plan nor the press conferences, to Min's point, actually gave you a lot of details. But all that being said, just to throw this forward, right? So according to Goldman Sachs, the two events to watch coming up will be the April Politburo meeting, as well as the nationwide childcare subsidy. So watch for that in the coming months. HSBC had a somewhat different take, fairly more bullish, fairly more comprehensive. A decisive change is how HSBC calls that as well. So it's unclear, again, to Min's point, how the trade policy or the trade war may evolve. But the shift to focus inward, look at domestic demand, is the best response yet. This puts more upside risk to their forecast of 4.5%. Let's bring in David Chu, of course, who's with us here on set as well, to give us their reaction to what you heard so far.
Well, yeah, if you look at the whole, from my side, I have been reading the word lifting consumption over the past decade for maybe 1,000 times. Yeah. So, yesterday when we came to the press conference and the document he issued in the over the weekend, and the Min has briefed it a lot, and I don't want to go through everything, but I want to say that yes, they gave some detailed and concrete ways to lift the income. So I think this makes the most difference compared with previous documents. And also, they decide that they are going to improve the social security's welfare, and also, for example, to give subsidies on no loans for children. These are all in the good direction and the correct direction in my way, in my thought. So it comes to another thing in my mind, that this is the first priority to-do thing in the government work report. If you look at it, it is the first thing in the to-do list. And last year, it was the third one, so that it tells us that for this year and maybe next year, this is the top priority for the economy policy and the policy orientation, in the government's to-do list. And we should say that this is really relevant to the economy situation. We just talked that China's economy is resilient, but I want to say it is resilient in the production side, but less resilient in the demand side. If you look at the demand side, export is facing great uncertainty because of the tariff, and the investment is dragged by the real estate sector a lot over the past 3 years. And now only the domestic consumption is the hope. It's a silver line for the economy in the demand side. So that is why it is the first top priority for this year.
The demand side problem, it would be a big shift for Beijing to really focus solely on that. But it's also very difficult, if not the most challenging sort of policy shift for them to engineer, not least very expensive. What are the key challenges here? And to what extent is this sort of stimulus package responsive to the backward-looking data that we saw for January, February? Or is this sort of a forward-looking approach, thinking about Trump, thinking about how it's going to deal with the US and global tariffs?
Yes, I think it's a more forward-looking one, because if you look at the track of the policy changes, you would see that from last year, from Q4, the government has called that the consumption is the key for the economy, and they show a strong willingness to lift the consumption. So I would say it is an outlook thing because of the uncertainty, as I said, uncertainty in the tariff side and in the export side, and also the sluggish investment side. So that, yes, it is a forward-looking thing. But the key difficulty or the key challenges is that how can we improve consumption in the short term? If we want to do it in the longer term, it would be easier because we have, for example, we can do it within 5 years or 10 years. We are lifting income of households and also to build up more social securities and such a kind of things to let people be more willing to spend. But how can we lift it in the short term? Because the external shock will take place in the short term, so that we need the consumption to offset that in the short term. So to do this, I think the fiscal side needed to do more.
Okay. Team, thank you so much. David Chu, of course, our from Bloomberg Economics, and here on set as well is Min Lo, of course, our China correspondent. Right, more on the breaking news that we've gotten in the last, let's call it 30 minutes or so. So a bit of background here before I get into the latest lines here. So earlier on, we did see some news that Israel was striking Hamas targets in Gaza. Now, more context coming through out of the Israeli Prime Minister's office commenting on that these strikes were in response to the refusal on the part of Hamas to release hostages, and that they will act against Hamas with increasing military strength. And now you can see, of course, these are live pictures coming through I believe, out of Gaza right now. So we'll keep you guys up to date and up to speed, of course, on more developments coming through. Certainly a risk to watch as we go into the thick of the trading session this Tuesday. Good morning. We're set for gains, as you can see, across these Chinese markets. So we're looking like, and we could actually be testing the recent highs in some of the Hong Kong benchmarks, and a couple of stocks like BYD. We'll talk about this later, but perhaps we could see a record on that stock given just the moves overnight, right? I'm not speculating. I'm extrapolating based on the news flow and what we've seen so far. Anyway, we'll table that for now. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. Good morning and nice to see you, as usual.
Good morning.
We're trying to figure out how much the markets already discounted. Chinese markets have discounted based on all the stimulus that's been announced, and what looks optimistic and what looks maybe a bit more longer term.
Right. I don't think the Chinese market have discounted very much. If you look at the rally since January of this year, it's very clear that the rally was powered by a micro-thematic theme. It's on the back of optimism around AI. So if you look at the offshore stocks versus onshore stocks, the tech stocks versus non-tech stocks has fly high, but the non-tax part actually resisted very modest gains. So I think it's very clear that the market is trading on a secular micro themes, which is making the rally less sensitive to macroeconomic shocks. That's why the market is being able to power through, you could argue, a mediocre NPC, 10% additional tariffs from the U.S., and a daily dose of negative headlines coming from the U.S. almost over the past 2-3 months. So I think market hasn't really discounted that much of a policy stimulus, but AI certainly is in the market.
Okay, so what does it take to, I suppose, shift that momentum from being a micro-secular theme to something that is broader based? And is this consumption package that we've seen, even this shift to sort of the demand side emphasis, is that not enough to do it?
I think you need to see more of this. So clearly that the consumption, the 30-point consumption support package, it's a move in the right direction. It's coming on the hill, coming on the shortly after the National People's Congress, where they said that they're going to make a consumption the center of policy stimulus. So with this, 30-point plan, we're getting a little bit more details of how they're going to carry out this consumption support package. However, we don't really see all the details, right? We don't know how big this consumption plan is going to be. We don't know the implementation details. We don't have the information about who's going to pay for this consumption package. So I think this is definitely a move in the right direction. But the reason that you haven't really got the market really, really excited, the broadening of the rally and the consumption stock really fly high, it's because of the lacking of those details.
Is the lack of detail by design? And the reason I bring it up because we don't know what factors and how the economy looks in 6-12 months' time. We don't know how geopolitics looks, for example.
Sure.
In other words, is that necessarily a bad thing?
So I think last time I was on this program, I used the phrase crossing the river by filling the stones.
Yeah.
I think this is a very much an iterative process. They have a promise of hitting around the 5% growth target. They tell you what they have told you what they're going to do in terms of stepping up a fiscal stimulus. A lot of that resources are going to be channeled into consumption and technology development. This is 30-point plan is essentially the next step of getting people comfortable with that plan. But clearly that they don't know how the external situation is going to evolve. They don't know the domestic economy is going to pan out over the coming months. So I think they are keeping the powder dry, sort of react to the additional developments coming from internal and external arena.
So, as I understand it, correct me if I'm wrong, your view, as is sort of, we can probably say consensus in the market, is the stimulus package that was announced is just about enough, perhaps not quite enough, to deal with the tariff offset. I suppose I'm curious as to whether you agree with our Bloomberg economics economist who just came on saying that the issue for China is really the timeline here. They need to get consumption going in a very short period of time. They don't have a 5-year horizon. It's sort of a 1-year horizon. Do you think is the timeline issue the most pressing concern for offsetting those tariff risks?
I think both the timeline as well as the scale are both important. So if you look at the 30-point plan, it deals with some short-term cyclical issues, but it also covers the longer-term secular issues as well. On the short term, you have the consumption subsidies, you have the pledges to stabilize the labor market, stabilizing wage growth. You have quite a decisive sort of support for housing market and the property market as well as equity market to create a wealth effect for consumers. And for the longer term, you have initiatives to deal with the demographics, right? The subsidies for childbirth, childcare. You have things like increasing the competitiveness of the services sector, liberalization of the services sector, and you have a lot of initiative to show up the social programs, social unemployment subsidies, recreational social benefits, you have measures to increase education and healthcare, so on and so forth. One of the key reasons why Chinese consumers are very swift is because they don't have the government saving for them, so they have to increase the discretionary savings, and their consumptions obviously take a hit from that. If the government are saving for the households, then they can bring down that discretionary saving and increase the consumption share of the GDP.
I mean, you bring a very unique perspective here because you're both an economist, and right now, of course, you look at markets. So my question is, and I think just to build on what Rebecca was mentioning there, it's the first time in, as far as at least I can remember, that consumption is number one, right? When you come to GDP, there's consumption, there's exports, there's investment. The other two are easy, right? We can meet the target this way. So my question is, 30-point plan, the toolkit is arguably still geared towards the old economy. How do investors need to be thinking about execution risk?
I think execution risk is very much the key. As you point out, that this is very new, right? This is not the old playbook that local government, central government have been comfortable with, sort of stimulating the economy. With investment and property and infrastructure-driven sort of a playbook, it's very easy. Once you throw the money, the GDP got to reflect it. I think consumption is a new model, and that's why maybe that Beijing has been hesitant in sort of moving in that direction. But I think the wake-up call is finally being sound. Right. We have seen that the consumption being center of the stimulus from the Central Economic Work Conference, from the 2 sessions, and now we actually have more concrete plans being laid out. So I think, to me, the significance of this announcement is not so much of delivering the concrete implementation details, but it's laying the groundwork and tell you the direction of travel.
More with Aidan now coming through as well here. Just very, very quickly, going into the open today, BYD is set to open at a record high. We're now called 406, 407, 408 rather, on the stock price right now. The bulls are out this morning. A good morning it is, as you can see if you're along these markets. So the Hang Seng Index is now set to open at a 3-year high. So it was a level we were tracking. We took that out really in the pre-markets right now. So at these levels, we're at the highest level here, coincidentally, since Michael Jordan's birthday in 2022, Feb 17, 2022. We're set to open higher. BYD at a record. The bulls are out. Good morning.
Good morning and welcome back. You're watching The China Show. We are counting down to the open of markets, about 40 seconds and change off here. And really, Dave, looks like a very happy day for markets. We did see a bit of that positive momentum coming through yesterday. Of course, that really was focused around, in part, the consumption news that that was trailed quite heavily on the weekend. We saw more details of that coming through at a briefing. Although, as our China correspondent highlighted earlier, no major fireworks. But this emphasis in shifting to the focus on demand away from supply, quite a significant move in terms of the tone and the long-term view from Beijing.
Yeah, I mean, they've told us in so many ways and so many times that, it's consumption, right? And I think the message has, slowly permeated in these markets. And now we understand it's consumption, even though short-term we might not actually see that come to fruition, that the bullets have been saved. To Rebecca's point, right? So it's risk appetite really coming through out of the U.S. Plus, you have some idiosyncratic stories playing out within the Chinese markets themselves. So, BYD is a case in point. We'll talk about that in a moment. Wuxi App Tech is up 10%. Baidu's up 8%. Alibaba's up 5%. So in terms of market breadth, you do have the DeepSeek, the AI story, rather, just to broaden it out a little bit further, on top of some of these sort of feel-good corporate stories coming through. As it pertains to the mainland, we're back up at the 4,000 level. Momentum in the early goings this time yesterday actually didn't hold going into the close yesterday. So I think we did close over on the mainland benchmark today. We'll talk more about geopolitics in a moment, but just the reason I bring that up, just to mention that Donald Trump said that the Chinese President Xi Jinping will visit Washington in the not-so-distant future. So keep that in mind. No date for that, obviously. Very quickly, have a look at Hong Kong in the open here. So 2% up in the early goings, 24,622. On the Hang Seng Index, just about every single thing is up right now. I can look at my screen. So the Hang Seng Index is 79 up, 4 or 5 down, 0 unchanged, just about across the board. 200-day moving average to the downside is the support level here on dollar China, the opposite, obviously, for resistance. Baidu's up 8%. Alibaba is 4.6 to the upside. Let's change the page. And, of course, the stock we're tracking is BYD. So you have this Reuters report on possibly a third plant in Germany. Point number one. Point number two is, of course, this unveiling of this new charging system, which effectively allows people to charge their EVs in about 5 minutes. So perhaps a game changer there of better things to come. China Hongqiao, this is a corporate action story. So there's a convertible plus a buyback, which I think to me is separate. I'll correct myself if I'm wrong there. Yep. Convertible bond price at $20, 20.8. It's also expected to repurchase 20 million shares thereabouts here at $14.60 a pop. Okay, very quickly, final glance at some other movers here. There we go, Choong and CK Assets. You guys are probably all across this, the port story, and of course some of the commentary coming throughout of the mainland and the pushback there. Ming Pao reporting here, this is the local paper, of course, in Hong Kong, that CK Hutch and CK Asset, and I think they're holding their earnings later this week, will not be holding briefings for their full year results. I won't speculate why, but that's what the report is all about. There we go.
Well, we don't need to speculate why, but there is context here, which is, of course, the criticism that we've seen from Beijing, essentially, over the ports deal.
Yeah.
And some quite robust criticism, too.
Yeah.
Anyway.
Fairly clear one there.
Big day for China markets.
Yeah.
We continue to focus on that. And we're back with Aidan Yao, Senior Asia Investment Strategist at the Amundi Investment Institute. I want to pick up off Dave's point, touching on geopolitics a little bit there. The US story. We really do now have a sort of tale of two narratives. On the one hand, fading US exceptionalism. On the other hand, this big, deep-seek, micro-secular momentum rally that you're talking about. Which one is pulling international investors into Chinese equities?
Both. Right. So I think this fading of U.S. exceptionalism is driven by both the developments within the U.S. and outside the U.S. I sort of characterize this U.S. exceptionalism by three things. A very resilient economy over the last 2 years. Everybody thought that the U.S. were going into a hard landing 23, 24, no hard landing whatsoever. Policy was very supportive as well. Obviously, monetary policies was in a tightening sort of a territory, but fiscal policy was outrageously expansionary. And number three, you had the AI thematics that powered Max 7 higher and dragging the entire market higher with it. You can see that all three of those drivers of exceptionalism are fading. U.S. economy is running into a wall. We don't think it's going to be a recession, but certainly the slowdown is very clear. U.S. policies, whether it's trade policies, are hurting the consumer confidence. Monetary policy, the Fed is on hold with interest rate in the tightening territory. And fiscal policy on paper is still expansionary, but with what Doge is doing certainly doesn't feel expansionary on the ground. It feels like the U.S. government is undergoing quite a severe austerity. And then finally, on AI, I think rise of DeepSeek is upending the old model. Before the rise of DeepSeek, Max 7 was the only AI game in town. And now we have a much diverse range of possibilities to play the AI themes. A lot of AI companies in China are being bought by U.S. Global investors. So clearly, the U.S. development is fading that U.S. exceptionalism. And what's happening outside is accelerating that trend as well. With Europe, the German elections has brought a watershed moment with respect to infrastructure and military spending. And in China, I think China really represents a much more formidable challenge to that U.S. exceptionalist story. If I use those three things that underpin the U.S. exceptionalism, economy, policy, and AI, DeepSeek has brought AI thematics for China. So China is now enjoying this leadership in some areas of AI development. Policy, the policy predictability and accountability is almost night and day between U.S. and China nowadays. In the U.S., you can't even predict what Trump is going to say or do tonight. Whereas in Beijing, they just told you that they're going to hit around 5% growth for this year. And finally, the economy. I think economy is really the only missing link. Right now in China, we don't have a broad-based stabilization of the economy, but we do have some green shoots. Right, top-tier cities, property market. We have just seen yesterday the better than expected the January and February number. With the policy really hitting the ground, I think that stabilization could be a byproduct of a more forceful policy coming through. So I think the stars are getting aligned for the Chinese market to perform.
I'm just trying to think whether it's useful to think about the pullback in U.S. markets almost as a one-for-one in China. In other words, there is an overlap of investors there.
Sure.
I would imagine there's still a group of investors that have yet to be sold on the China story. And if they are sold on that story, they probably will only go into the usual tech names. And I'm wondering where the incremental buyer will be coming from.
I think the incremental buying could come both within China and from the U.S. We have seen a lot of hedge funds participating in the recent rally, but the global long-only investors have not really been going in wholeheartedly. The most of the buying since January was essentially southbound flows, right? The mainland Chinese money. And you can understand why, because for the past 2 years, Chinese investors have been absent from this AI thematic. Because of capital account control, they can't actually buy U.S. stocks. And before the rise of DeepSeek, they were not aware of the behind-the-door progress in China's own technology development. So DeepSeek is really changing that calculus, and we're starting to see a lot of mainland Chinese buying the best tech companies that listed offshore. So I think with 160 trillion of deposits still sitting in the bank, I think even without foreign investor participation, this is still a lot of buying power to sustain this rally just within China. But as this rally continue to go on, China continue to outperform. A lot of those underweight by global only investors will have to think twice. So I think the incremental buying coming from both within and outside China can be quite significant.
One way to sort of describe that phenomena is that the optimism in a Trump put is fading in favor of a Xi put. And I'm curious, in your view, what is the biggest challenge or the biggest downside risk to that Xi put?
So firstly, on the Trump put, I think a Trump put has moved from put for equity market to put for bond market. Given that, Trump 1.0, he cares about equity market, but in 2.0, through the mouth of Scott Bessent, it appears that Trump cares a lot more about the bond market. So I think a Trump put is still live and kicking, but it's just that it's shifting from one market to another. For China, I think clearly the Chinese authorities are not sort of laser focused on the equity market on a day-to-day trading basis. But clearly, with this 30-point plan, it has identified the equity market as one of the channels indirectly to boost consumption through wealth effect. So I think that's a sort of a medium-term or longer-term safety net for the equity market, right? So I think there's a bit of a comforting from that perspective for equity investors.
Yeah, there we go. Markets are content for now, locked and loaded and ready to fire. That's the Amundi headline here in one of the latest reports. Thank you so much, Aidan, their senior investment strategist. The case for China there at Amundi Investment Institute. Right. Just some breaking news, of course, we've gotten in the last, let's call it 40 minutes or so. So these strikes that we've seen out of Israel into Gaza targeting Hamas targets. We've seen the likes of gold, for example, catching a modest bid in the last couple of minutes or so, maybe on the back of that news. Let's bring in John Herskovich. I believe he is with us right now to talk us through this breaking news that we have so far, a Bloomberg editor. John, thank you for joining us fairly last minute. Yeah, why don't you get our viewers up to speed? What's going on here?
Yes, we've gotten information that Israel has launched its largest strike in Gaza against Hamas. And this is the biggest operation since the truce a couple of months ago. And it's something that seems to could threaten the truce that was brokered. We've heard from Palestinian residents that there have been multiple Israeli airstrikes in several parts of the country. Israeli Prime Minister Netanyahu has vowed his government will go after Hamas with increasing military strength, accusing Hamas of violating the ceasefire, and Hamas is accusing Israel of violating the ceasefire as well. There's also been some separate reporting. The Associated Press is citing Gaza's Ministry of Health as saying at least 44 people have been killed in the airstrike, something that we're looking into.
John, so the first phase of that ceasefire agreement had come to an end. I suppose the question now, to the extent that we can answer it, is what comes next?
It's really difficult to say. There have been talks going on between mediators, including the U.S., Qatar, Egypt, but they've made little headway. And with what's going on today, this could be a game changer for the negotiations. We'll see how it develops, but this is such a large movement, it seems, and with these talks not making a lot of progress for the next phase, this could change the way things have been going out with the negotiations.
OK, John, thank you so much for sticking with it. And of course, we'll bring you more details on that story as we get them. That's Bloomberg's East Asia government editor, John Herskowitz, there joining us. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
Right, welcome back. You're watching The China Show, 14 minutes into the session. One stock we're watching is 1810 HK. Shares of Xiaomi there. Should be moving higher, going into 2.4% to the upside here ahead of earnings later today. Likely to record its fastest growth in about 4.5 years. Let's bring in Annabelle Jewellers, a tech reporter, here with us to tell us what the key areas to watch out for here.
Well, there's going to be a few different ones to watch. I think we can start with the smartphone division. This is still the major part of the revenue of the company, so it's going to be just under half, or that's the expectation. Smartphones themselves, I mean, the market is sort of stabilizing, and actually Xiaomi is following a premiumization strategy where they're trying to sell more high-priced devices, and so we could actually start to see the margins improving a little bit in that. What else is going to stand out? And this has really been one of the most interesting parts of Xiaomi, is the EV business, because they started selling their SU7 in April of last year. It seems to be, they're ramping up deliveries. Essentially, they're selling at higher price points as well, because they've seen lots of the Pro and the Max ones going out. So this is solid for the business. And then as well, the last one to watch is the IoT business. That's the Internet and other things and lifestyle. And that's really important to watch because Xiaomi essentially has a strategy where they're following what they call the whole ecosystem, where you have the human, so you can equate that to, it's really the smartphone. There's the home, so that's all of the home appliances. And then you have the car, and that's obviously the Xiaomi car. So they're essentially trying to capture all of this, your home, your device, and your car. They want all of that to be Xiaomi, and that is the strategy they're following. I mean, you've seen it being reflected, I guess, how it's being executed in the share price so far.
Yeah, Xiaomi everywhere, everything, all at once. And we're maybe sort of even seeing that in the share price. Price of perfection, perhaps overpriced?
Yeah, I mean, I think that people would also say the long-term growth story for the business is still intact. But at the same time, yes, we have seen a very significant run-up in the share price. So it's nearly quadrupled over the past year. It's up nearly 300%. And you're at a point now where the share has risen so much that it's actually outpacing the average price target that analysts have for the stock. So it's really, something to track very closely. In terms of what we're seeing for the numbers tomorrow, certainly you've got investors or traders that are boosting their options bets, and they're also seeing greater volatility, or that's the expectation. They're pricing that in. So where you might typically see a move of maybe 3% in either direction for Xiaomi after earnings, tomorrow we can expect to see maybe a 7% jump or possibly drop. But that's what we're seeing so far implied.
Wow.
Yeah, great context there. Thank you so much for joining us, Belle. That's Annabelle Jewellers, our tech reporter, joining us. And, of course, we'll have more on Xiaomi's earnings and outlook tomorrow when we speak exclusively with CFO Alain Lam. That's coming up on the Asia Trade at the various times on your screens now.
Right. One of the stock we're tracking right now also has done exceptionally well. In fact, we just took out the recent high is BYD. 4.5% at about 403. We're coming off highs a little bit, but I believe we should still be above the pre-cash call level there intraday. Let's bring in Daniel Lee to tell us really what's going on here and all the bullishness around the stock here. Tell us about this BYD event.
Yeah, so BYD, the investors reacting to an event last night, BYD showcasing ultra-fast charging cars, a whole new lineup of models that we based on much more powerful, robust batteries, but critically with super fast charging that basically gives you the same amount of range or power in 5 minutes in the same time it takes to charge a gasoline car. So it's a whole new suite of tech and infrastructure that BYD is banking on to really accelerate the sales of its fully electric EVs, particularly as it made upgrades to its plug-in hybrid models last year, and that itself saw sales soar. So this is a huge bet on them for them to try and really elevate sales even further.
We have a nice big take on the terminal and on the web today, really looking at the global context of the rise of Chinese firms. In part, the tariffs that we've seen from President Trump have been to protect Detroit automakers from this sort of rapacious expansion of Chinese EV makers and automakers. Just tell us about that phenomena.
Yeah, it's fascinating that tariffs in the US try to protect automakers at home, but they're not actually going to protect them abroad. The rest of the world, frankly, where you see on the streets of Sao Paulo, Johannesburg, elsewhere, including Bangkok, huge volumes or increasing volumes of Chinese EV brands and brands in general coming onto the street, and they are matching up to the likes of a Volkswagen or even a Ford or a GM branded car. And so the relative success and the increased proliferation of these Chinese cars on these foreign roads just speaks to the success that they're having by encroaching on the territory that was very much once the kind of stomping ground of the foreign automakers. And yeah, it does speak to how these tariffs, whilst they'll protect the automakers in Detroit at home, they're not going to do much in the rest of the world.
So how do they measure success then, if they've been so successful, I guess, in sort of cornering out, some of their foreign rivals then?
When you just look at the pure numbers, and even if the numbers look small, for example, Thailand, where the Chinese brands had, 5.5% market share 2 years ago, now that's at 13.3%. Then globally, they're looking to push on to around a 33% market share globally, if you include China, by the end of the decade. And that's a really big advance on where they stand now, considering how the cars that the Chinese brands used to make of the last few years were maybe not as popular. Now they've gained huge traction over the years. So yeah, a lot of inroads that they are making.
Okay, and in 30 seconds or less, is this a cautionary tale for top-tier automakers?
Yeah, I mean, I think once they kind of recroach from or exit certain markets, it's the Chinese brands which are coming in, whether taking their market share or taking their factories.
Okay, well, you took only 20 seconds, not even, actually 12 seconds there. Fantastic. Daniel Lee, our transport reporter. You can read, by the way, that big take piece, fantastic, by the team there, and how cheap Chinese cars are winning over buyers around the world, threatening, of course, their rivals from the US, Europe, and also Japan. Check it out, and a big take for our clients, Bloomberg.com for those on the internet. Plenty more ahead. This is Bloomberg.
Right, welcome back. You are watching The China Show, and here are some of the top corporate stories that we're following this morning. Hong Kong's New World development is said to be in talks with luxury giant Louis Vuitton to open a mega store in one of its signature malls. Sources say the shop would occupy about 40,000 square feet at the K11 Mosaic complex, making it one of Louis Vuitton's largest in Asia. We're told it could feature a museum, a cafe, and a lounge for the brand's VIP customers. Alphabet is said to have restarted talks to buy cloud security company Wiz for $33 billion. Our sources say a deal could be announced as soon as Tuesday. A tie-up would be Alphabet's biggest ever acquisition, boosting Google Cloud cybersecurity offerings to help it compete against the likes of Amazon and Microsoft.
Now, if we look at markets, and really the emerging major story in the last hour or so have been these strikes in Gaza, targeting Hamas targets here out of the White House, out of Israel. The reason I mentioned White House is the White House was consulted on those strikes by Israel tonight, of course, U.S. time, you had the press secretary there in an interview with Fox confirming that they were consulted ahead of those, I would imagine. You're looking at, I guess, some of the affected assets across markets right now. Gold futures are up. Effectively at a record here. The dollar's catching a very slight bid. Not much reaction as far as the VIX futures are concerned, so we're slightly lower there as far as the contract here in the trading in the Asia Pacific. Right, just going into the 24-minute mark here of cash markets, and we are doing very well across greater Chinese markets, still holding at about 4,000 in the CSI 300. We have paired a little bit there from the very top, as well as the Hang Seng Index, which, a lot of these benchmarks did open about 2-3% higher. Still some decent gains, though, and I think we're still looking really on what happens as far as volumes go. Turnover, and just a quick nugget, right? So the southbound connect, the flows yesterday topped, I think, 12 billion, which was right at about the recent averages. So we'll have a look at that and really how much buying is taking place underneath the hood as we digest, of course, the rally that is taking place right now. So, yeah, as we were pointing out earlier on, the bulls are out this Tuesday. Plenty more ahead here on The China Show. Welcome back. You're watching The China Show. A look at, first markets and, of course, Hong Kong here, where if you're in the city, we're actually experiencing our fourth winter this year so far. I was a bit underdressed when I went for my run earlier on, but, there was no one around anyway to notice that. 1.8% to the upside on the Hang Seng Index. We are set for the best day in about 2 weeks or so. In fact, just to look at what's driving this market, it's effectively everything. So in terms of market breadth, we're there. Volumes are there. In terms of some of the big names and points movers here, BYD's up 4%. That's really down to this unveiling of this new charging system, which allows you to charge your vehicle in about 5 minutes. Game changer that would be allowing you to do that for your phone, actually. Think of how big of a game changer that would be. Anyway, that's not their problem anyway. They're not a phone. Maybe Xiaomi could come up with something like that, right? Because they're both a phone. Anyway, Alibaba, 4%. Baidu's up 11%. And Wuxi takes an earnings story, revenue meeting estimates. Plus, you do have a special dividend there coming out of the company, plus a share buyback in the order of about 1 billion renminbi. Right, Asia ex-China, we are doing well. And you have several pillars taking place today, right? We'll talk about Japan in a moment, but that's really one of them, 1.5% to the upside. So you have Japan, you have Hong Kong. That's really enough to lift the benchmark here in the order of about 1%. So it is risk on today. Let's bring in Mark Cranfield out of our MLive team to talk us through this. Mark, why don't we start with Japan? And the Warren Buffett effect is again alive and well there.
Yeah, not just the Warren Buffett. Obviously, people are very pleased to see him put more money to work in some of the big industrial companies there and the trading houses. But you've also got the bank stocks as well. Yesterday, we had 40-year JGB yields reach the highest for more than 2 decades, which is pretty exciting because the curve is steepening so much. It's very good for the bank earnings outlook. We won't get another clear read on their earnings until May. But obviously, people are getting very excited because the banks already put in a very good performance when they reported their last set of quarterly earnings. So there's a lot of optimism in the banking sector. Look, even in transportation, people are excited because there's some kind of tie-up going on between Toyota and Honda, which maybe people are thinking, speculation that maybe those two companies are going to get closer together as well. So that's good news in the transportation sector, plus the tourism impact what it's having on the Japanese rail companies. So it's really across the board. There are several little pockets of positive news across the Japanese markets. And if you look at the way that the Topics Index in particular, basically it's gone sideways since about October last year. So it's really lagging behind the performance of several other markets, particularly in Asia, when you look at what's happening in Hong Kong and China. And for now, the yen has weakened again slightly. They've got a lot of political disturbance going on again in Japan. That'll probably keep the yen a little bit on the back foot. Again, that's good for the exporting companies. So there's a few stories pulling together, which is starting to make Japanese equities look exciting again.
Mark, we've also got 3 of the 5 biggest names on the Hang Seng Index reporting earnings. Xiaomi, Tencent, Meituan, all coming through this week. Is that the biggest catalyst we should be watching for Chinese equities this week? And is there any downside risk here? Or what is that? What does that look like to you?
Well, there's always some downside risks, but we're trying to look past those for the moment. All the things that David was talking about earlier, they're all very positive. But if you want a couple of takeaways just this week, in addition to the fact that people are getting excited about the AI story again and how that might start to boost the earnings of the big companies you talked about there, although it's more the outlook rather than the actual numbers that people will be looking for. If you think of what happened on Monday, we had a big set-piece press conference out of China talking about some stimulus. Now, overall, it wasn't really an exciting thing for investors. Most of the information was released in advance. And what we've seen in the past is that when there's a bit of a damp squib from these kind of events, the following day, equity markets slump in China and Hong Kong. That's not the case this time. People absorbed it very well. There's been no after effect from the press conference at all. And if you look at what's happening in the Hang Seng Futures Index, the open interest positioning is way below where it was back in September, October last year, during that big surge, the first time that we had stimulus measures coming out of China. So it's telling you that although the market's been going up for the past few weeks, trader positioning is not overextended by any means. So that means there's plenty of room for this to run. If we continue to get positive stories like BYD, if we get good earnings, as long as we get a regular feed of good news coming through, this Hang Seng rally could go on for quite some time.
Mark, can I just ask you about geopolitical risk? In the last hour, we've had news on Israel striking some targets over on the Gaza Strip. You know, I'm looking at the likes of gold, for example. I think in case our viewers miss it, gold's actually up almost every single day this month. How do I need to be rethinking about and discounting these risks, for example? And, of course, not to discount and not to trivialize anything else there as well.
I think that the geopolitical risk is more to do with the Europe and the Ukraine situation rather than what Israel are doing here. Today, there's a huge vote in Germany. We get the first stage of the approval process for Germany to really increase spending, particularly in the defence sector. It's likely to go through. All the news so far suggests that the government is going to be able to push it through. They will get the support they need, and then that's a massive injection of spending for Europe because they're concerned about the situation between Russia and Ukraine and the US pulling back in defending Europe. That's a geopolitical issue which is translating into higher equities in Europe. It's also pushing up yields in Germany especially, and it's also boosting the euro. So if we get another confirmation that this vote has gone through, Germany's got the money, we'll probably see another step up in the euro as well. The flip side is it knocks the dollar down a bit further as well. That's really the biggest geopolitical space at the moment is really centered around Europe. And it looks as though that's going to have knock-on effects across currencies, bonds and equities, and probably will continue to do so for some time.
OK, excellent. Mark, thank you so much for joining us this morning. That's Bloomberg MLive strategist Mark Cranfield there. Now, really touching and staying on that theme of geopolitics, Israeli Prime Minister Benjamin Netanyahu has ordered fresh strikes, military strikes that is, on the Gaza Strip in response to Hamas's refusal to release Israeli hostages. The move shatters nearly 2 months of a very shaky ceasefire that had paused 15 months of fighting. Bloomberg senior editor Bill Ferries joins us now from Singapore. Bill, I mean, let's just focus on the latest on Gaza. What do we know so far, and what's next?
Well, the reports are still coming in, the early reports about these strikes that took place after midnight. Both Palestinian sources and the Israeli government saying that strikes took place throughout the Gaza Strip. Israel saying that Hamas's refusal to free the hostages taken in October 2023 was behind it. And Hamas saying that the renewed strikes basically mean an end of this ceasefire that's been in place for 2 months. And in a warning, they said that this potentially puts the fate of the hostages that they still have at an unknown, puts them in an unknown fate at this point. So it's the biggest escalation we've seen in the violence since this ceasefire went into effect. And the U.S. saying it was consulted on these strikes and White House Press Secretary Carolyn Leavitt saying that if Hamas doesn't move to free hostages, that, quote, all hell will break loose.
Can we still call it a ceasefire? What does it mean for that?
I don't think anyone is really declaring the formal end of it, but this phase one of the ceasefire really had kind of concluded a few weeks ago. They're supposed to be trying to work on a second phase. That seems unlikely to go forward. I think we're just going to have to see whether this is a one-night series of strikes or whether it just continues in the days ahead.
OK, Bill, yeah, a lot of uncertainty there. Elsewhere, we do also have news and reports of Trump, Putin talking on Ukraine. What do we know there?
Well, we're expecting the two leaders to speak on Tuesday in the U.S. We don't know really the specifics of what they are going to focus on beyond President Trump's comments that they're going to talk about dividing things up. So presumably territory, land, and President Trump said that power plants and energy would be the main topics discussed. The big concern, of course, in Kyiv and across Europe is that President Trump and Vladimir Putin will try to reach some sort of an understanding about how to wind down this conflict without Ukraine, without any of the other European partners at the table. So there's going to be a lot of anticipation and, frankly, anxiety in Europe about how that conversation goes.
Bill, thank you. Bill Ferries, they're getting us up to speed here, our senior editor in Singapore for us. Coming up here on shows, we will be speaking with UBS, this new initiative. Anyway, we'll understand, of course, what this means for the bank here, this unified global banking unit. And Selina Cheung, of course, who heads that for the Asia Pacific, will be joining us in a couple of minutes here. Stay with us for that and more. This is The China Show. Good morning. Welcome to the show. So the state of Asian equity markets is this. Really, it's three bits here. You have China, you have Japan, and you have everything else. Volumes are heavy where price is better. Let's put it that way. So you have the Hang Seng Index in Japan going into its lunch break. Last 18 minutes of the session, thereabouts there. And we're going into 45 into the cash market in mainland China here in Hong Kong. We're coming off highs of the day, just to note there as well. In terms of market breadth, just about every single stock is up with the exception of a handful on the Hang Seng Index. Right, let's talk about banking, shall we? And this revival, I think, in one part of the IPO market here in Hong Kong, this sort of wealth exercise that we're obviously we talk about day in, day out here in Hong Kong. Well, UBS is really, if you think about it, really at the center of this. They're increasing their focus on ultra-high net worth segment in the Asia Pacific. Its global co-head of wealth management, Iqbal Khan, in fact, relocated last year from Zurich to Hong Kong. And, of course, the Swiss banking giant also set up this new unit to deliver investment services to the ultra-rich. Let's get more with the head of that specific initiative. Joining us here for her first TV appearance since taking the role as Selina Cheung, head of Unified Global Banking for Asia at UBS. Unified Global Banking, that's a new concept I haven't heard. What does that mean?
So for us, global banking in UBS is really the traditional investment banking services. So unified actually just means that we're really providing this investment banking services to one of our most important client groups. And us being the largest largest wealth management bank in the world, I think this actually makes perfect sense.
And just to think about it sort of organizationally, is this about bringing sort of wealth clients to investment banking, or is this about bringing investment banking to wealth? And I guess in those two scenarios, where are the big opportunities for you?
Sure. Actually, it's a bit of both ways, right? So in order for us to actually get more investment banking businesses from clients from the wealth management side who, in APAC is especially relevant because a lot of these businesses or, families are also entrepreneurs. And so it makes a lot of sense for them to actually work very closely with the investment bank. But at the same time, we also have a very top investment bank in the region. And so we, in turn, also refer clients back into the wealth system. Now, in terms of the businesses that we actually do, there's a lot of the financings that we do, a lot of the M&A advisory work that we've done, as you have seen in the headlines most recently. And then from the other side as well, we would, all of these clients who are entrepreneurs also require wealth management services. And so, that flywheel has actually really been what UBS has been about. And so, our motto is always saying that we have a one bank approach, because we do think about clients both from their personal side, but also on their corporate banking side.
So with this new initiative, I wonder if you could tell us how large the group is here in Hong Kong. And
sure.
I know you have a capital markets background. Does it make more sense to have a wealth background, an IB background, a markets background? How did you guys come up with this group?
It's a bit of both. We have a team of, in total, call it 50 people globally. And so from Asia, we take about a third of that headcount.
Okay.
And
all full-time doing this, or?
In Asia, yes.
Okay.
So, and I think it's important, because what we think about is how important this wealth management business is to us in investment banking. And we have to leverage that, being the biggest wealth manager in the world.
I mean, to your point, there are a lot of reasons why this makes sense. So I guess my question is, why wasn't it done earlier? And sort of why now, right? What makes this the right moment to do this?
We've always had iterations of this in different formats.
Right.
We had representatives in sitting in wealth management side doing this. We also have a number of very top bankers who did this role as well. And I think now we're just really giving that additional layer of service, kind of like a sponsors team in an investment bank, right? Where we're actually providing client-facing servicing sort of way to actually access our client base, which is quite different from, a little bit more of a back office type role. We really want to be able to ensure that clients get the best services possible from an investment banking side.
And how do you guys measure, I wouldn't say success, how do you measure progress? Like, are there any targets, for example, that you've set out specifically?
Well, obviously, we're hoping to achieve a flywheel effect, both by referring businesses from wealth management into the investment bank, but also for us to refer more entrepreneurial clients and related shareholders back into our wealth management system.
Right.
And the opportunities specifically that you have in Asia and APAC, I know it's all full-time staff who are working on this team. What are you seeing as the biggest growth opportunities, and how does China fit into this vision?
Well, actually, our wealth management business cover China from different booking centers. So, we have China domestic arm, we have China international, we've got Singaporean and even US-based bankers who actually cover wealth management clients out or have a China angle or nexus. And so, this actually brings to us a lot of opportunity, especially with the recent rally and all the recent trades and deals and transactions that you've seen that UBS has been leading. And so, we see that there's a lot more reversing inquiries, even in the past few weeks, having seen that market rally.
And I'm not asking you to name your clients, obviously. That would be a breach of your relationship with them. But this recent pickup in deals and listings in Hong Kong, have you noticed, from your perspective, a pickup in interest from wealthy clients that may have been looking to list or raise money, for example? Has that come to fruition?
Absolutely. Absolutely.
Okay. Well, name the client. I'm kidding, but yeah, go.
Absolutely. And I expect that to continue, yeah.
Okay.
What about in the private market? What kind of appetite do you see there? And is it increasing, decreasing? How's that changing?
We've actually seen a very consistent focus on private market products, right? From our wealth management distribution perspective, the private market products is a very interesting and integral part of our offering to our wealth management clients. But also from the investment banking side, we've also got a lot of private market opportunities that we do share with our wealth management base.
Right, and this is how old is the team? About six months, roughly?
Roughly, yeah.
Roughly. You guys are figuring out things as you go, I would imagine. So, not that we're giving away the secret sauce to your competitors, but what have you discovered as, growing pains, for example? What are the challenges that you've come to realize of getting these two parts of the bank together and thinking about each other, for example?
I think less growing pains, but really just building trust, and that requires time. And I think building trust between the wealth managers, between the global banking investment bankers and our unified global banking bankers, and to work together towards a goal, and to give the best services both in wealth management and in global banking, I think is our goal.
How does that fit into what you see specifically in Asia? Are there things that particularly phenomenon that you have to sort of tackle here that may be different from elsewhere in the world?
Sure. I think Asia has a large proportion of entrepreneurs. And I think they think of a very entrepreneurial way, especially if they're first-generation entrepreneurs. And so we think that this division is particularly relevant in Asia because of that demographic. So they will have wealth management needs, but also investment banking needs.
And just looking at your footprint across the Asia Pacific, where have you seen the biggest pickup in activity, for example?
Well, recently, China, obviously, because the market has been picking up, both China domestic and China offshore. But, with the CS integration, we have actually had new wealth management teams in Australia and also a much bigger team in Japan. And a much more integrated team in India and Southeast Asia and Taiwan. And so I think for the newer divisions, the newer regions like Australia and Japan and Taiwan and India, we see a lot of growth that, we really need to tackle. But also because of the China rally, we've had a lot more business associated in that region.
Excellent to have you on, Selina. Thank you so much for coming and joining us this morning. Selina Cheung, Head of Unified Global Banking for Asia at UBS. And you can get an insider's guide to the money people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up via Bloomberg.com/newsletters. There's plenty more ahead. You're watching The China Show. Stay with us. This is Bloomberg. Good morning and welcome back. You're watching The China Show. Here are some of the top corporate stories that we are following this morning. Hong Kong's New World development is said to be in talks with luxury giant Louis Vuitton to open a mega store in one of its signature malls. Sources say the shop would occupy about 40,000 square feet at the K11 Mosaic complex, making it one of Louis Vuitton's largest in Asia. We're told it could feature a museum, a cafe and a lounge for the brand's VIP customers. Alphabet is said to have restarted talks to buy cloud security company Wiz for $33 billion. Our sources say a deal could be announced as soon as Tuesday. A tie-up would be Alphabet's biggest ever acquisition, boosting Google Cloud's cybersecurity offerings to help it compete against Amazon and Microsoft.
Okay, let's take a bit of time to have a look at southbound flows, right? So just for context, visually, you had the past few days on your screens, that massive spike that we had. What day is that? But so this is, sorry, I'm just going Tuesday, Monday, Friday, Wednesday. So Wednesday, Thursday, Friday, Monday, we had a figure at around 10 billion Hong Kong dollars net inflows. And the circle you see on your screens is where we are currently right now. So you are getting some inflows coming through across the Stock Connect, not as significant so far. Just to put a number there, that's around 400 million Hong Kong dollars so far across the Stock Connect. And the reason we bring that up is, again, this rally taking place in the Hong Kong markets, led by today, in this case, really some of the tech names as well. Now, coming up on your screen shortly, so you have the BYD effect and the unveiling of the new charging system. It's playing out on some of the mainland listed names that you see on your screens, right? So you have this new, in case you missed it, this new charging system is capable of providing, get this, around 400 kilometers of range in 5 minutes. So you do some stock moves in that, in many ways, perhaps a game changer here in the industry.
Pretty extraordinary, isn't it? And I have to say, actually, BYD do an event like this very, very well. I mean, they do they are really effectively able to sort of build this enthusiasm, and they do sort of save up pretty, sort of watershed moments. Yeah,
few and far between, but they matter. They matter a lot, right? And yeah, I think in this case, if you think about it, 5 minutes is effectively a power nap, right? For a car. Anyway, Japan trading house, by the way, something few and far between. Warren Buffett, when he talks about it, when he invests in it, it happens, right? So you have this announcement, of course, and by the way, the announcement of the upping of the stakes actually, I think, took place this week. But in recent weeks, they've already signaled that he was planning to build further exposure into these industrials, these old school Japanese industrials, and the ownership, as you can see on the right side of your screens, the companies and the stock reaction to the left, it's playing out as far as this is concerned. And as we go into, I guess, the Japanese lunch break, just to mention as well, it's not just this. Banks are rallying, this pickup in yields, there's a BOJ decision, of course, to tell you about. We'll talk more about that later. But yeah, it's a rally in both Hong Kong and also in Tokyo. Plenty more ahead. This is Bloomberg. Okay, welcome back to shows. We're just in time, you're just in time, by the way, to catch the last couple of seconds ahead of the Tokyo lunch break. And as we were pointing out, it's been a good day so far. Trading houses on the Buffett trade. You also have this yield pickup taking place. The weaker yen's obviously helping things along as well. So you have three pillars really playing out in the Japanese market. 1.5%, call it that. Banks are doing very well, as with the trading houses we were pointing out. Right, so in case you missed it, so 2, 10, 30, and 40. The 40-year yield in Japan, I think, was first issued back in 2006? Long time ago, effectively. So at one point yesterday, we were trading above 3% on the 40-year yield intraday, which effectively now puts us at a record high there still on the 40-year yield. 262 right now on the 30-year yield. Again, this conversation around the BOJ and where rates need to be, plus some domestic politics developments over the weekend and waiting support there playing through in the bond markets. Okay, that's point number one. And point number two is this is also taking place amidst this Chinese market rally, which we can talk about in a moment. But yeah, this broad consumption push and this massaging into the market mindset that authorities have been really taken a lot of time and effort to do is starting to play out here.
Yeah, that's right. I mean, and as expected, we are seeing this big push by the government, this big boost in consumption playing out in national media, making headlines there. One sort of example just want to pick out here is China Daily. It has this opinion piece saying the country's economic resilience limits the impact from U.S. tariffs. And I think this next bit is the important bit. It says the Chinese economy is capable of withstanding external pressures, proving that such resilience is changing the calculus of trade disputes, i.e. sort of tacitly saying here, look, this gives them more leverage when it comes to these trade discussions with China. And generally in state media, and although we've had a lot of sort of quite sharp commentary about tariffs and trades, we haven't necessarily seen this very direct comparison between why is it that the Chinese economy can withstand this kind of pressure. So interesting to see that narrative coming through. They do point out that China's dual circulation system, this is in the China Daily piece again, is unlike other export-dependent economies that can be crippled by major trade restrictions.
Yeah, meanwhile, you have the Global Times editorial here that says that Beijing's plan to boost, again, on this very theme, domestic demand, if done well, stating the obvious, will benefit China. Now, it says measures to stimulate consumption, including promoting wage growth and establishing this childcare subsidy system, have been welcomed by the public and welcomed by the markets, really, when you look at tech specifically. Let's get more on the rally taking place right now. We're about 62 minutes into the cash market session. Let's bring in April Ma, our equities reporter. She's with us in Singapore today. April, yeah, what are you guys talking about today in your team?
I think one of the biggest drivers, again, is tech, as we're seeing with the HS Tech Index today. But also, I think another bright spot is healthcare. So we haven't seen healthcare really jump to live very often in this rally, especially on the tech leg of it, as we've seen most recently. So the WuXi Tech earnings overnight and the fourth quarter order numbers that really picked up, as well as the guidance for 2025 coming back into the double digits, that's really gotten traders getting more upbeat about the sector in general. We've also had BYD and its supercharged platform that's come out last night, and that has also had traders talking and looking, further scrutinizing, like, where is the cost advantage of the other players right now. However, we did see some of that rally peter out from earlier in the day. What I wanted to point out was the fact that the premium of H shares, or the premium A shares over the H shares, has been narrowing significantly over the past couple of months. So I think that is going to be a key factor that traders are looking at as well. So when do H shares become more expensive than A shares? And I think that's when Southbound is going to become slightly more wary.
Yeah, I think the benchmark on that is the A8 share stating the obvious, A8 share premium index. I think we're at 130 right now, which effectively is a 30% premium. Apart from this, and I'm guessing since we were talking about the various sort of second derivative metrics here, April, what do technicals look like as far as this rally goes?
I think technicals say that we do need to see a bit of a consolidation, if not a bit of maybe not sell-off, but a little bit of a correction after all the gains that we've had, because we've now have the Shanghai Composite at above 3,400 points. That really is not that key of a level, but I mean, once we hit these whole numbers, I think is when traders are going to stop and think and say, do I still want to stay, or do I want to pull some money off the table?
April, we had Amundi joining us earlier, essentially saying that the rally that we've seen in Chinese equities is happening in spite of some of these consumption support measures, some of the stimulus announced at MPC, and it's really about the momentum around AI. And I wonder to what extent that chimes with what you're seeing in the market or not. And if we need to make a distinction here between how onshore investors and offshore investors are reading and viewing these measures by policymakers.
Yeah, I believe in this case, there's not that much disagreement between onshore and offshore. I think overall, both sides of the investment community would like to see more details, more specifics, and how these things will be followed through on. I do want to point out one of the things that the consumption measures, the consumption package unveiled over the weekend, mentioned was boosting people's incomes, and stocks has become a very important part of that. So we're not going to be able to count on property to provide that value up in the wealth effect, but stocks will need to take up the slack there. So that's going to help sentiment generally. It's not going to be an immediate boost, but I think it's going to be there on the back of people's minds. I think it's just more of an assurance that, stocks are quite key at this point in history.
Okay, thank you so much for joining us there. That's April Ma, Bloomberg Equities reporter. And let's get a little bit more of that broader market context now and bring in Thea, Jamison, founder and managing director at Change Global Investment. I want to pick up on that China theme just to kick off with. I mean, you have shifted your stance quite considerably when it comes to China.
Great to see you. Great to be here. Yes, we're very bullish on emerging markets, and China is a critical component of that call. But when I look at the asset class, I'm seeing a lot of positive change across the board. China is just one area of improvement with this clear shift to pro-consumption, pro-business. We're seeing incredibly compelling valuations, especially on the H-shares market, which are trading at a good 20% discount to historical averages, but really at a big discount to emerging markets as a whole. And finally, there is now an incentive, a sense of urgency to change allocation, because in the U.S. we're seeing volatility and the type of drawdowns that we have not seen in quite some time.
So where would you be looking to add exposure to China at this point?
Yes, so I think that it's very obvious that there is a renewed push to help boost consumption. So we're quite bullish on consumer-oriented stocks. One stocks where we have been consistently adding to is Trip.com. And the reason for that is it's exactly what we look for. We look for blue chip, market-dominant companies that have significant price upside. And Trip.com is just that. It has a 48% market share in online booking. It is, I also believe, clear that the new action plan is specific to tourism infrastructure, elderly consumption, right in the space of that domestic travel recovery. And lastly, Trip.com is making a pretty dramatic push overseas. Just in your backyard, in the Asia Pacific region, the market is estimated to be 1.5 times that of the domestic Chinese market. In fact, last quarter, Trip.com reported an 80% revenue increase in their overseas revenues. So we believe that between this positive outlook for the domestic market, improvement in the overseas tourism market, there is an opportunity for earnings revision at an already very attractive price.
So that's a really good point on, I suppose, the opportunities in terms of sort of the domestic consumption, but also overseas consumption. And I want to ask how you're factoring sort of geopolitics when you're thinking about some of these consumption names. Are you looking for names that are sort of very protected, that are mainly seeing and mainly supported by domestic demand? Or how are you factoring those sort of risks about export controls, tariffs and so on?
Yes, absolutely. So historically, we're always looking for this domestic orientation, markets that have idiosyncratic factors, drivers, risks. And the reason behind that is because when you combine the different unique markets and exposures, you can pretty effectively manage the risk of a global emerging market allocation. So in the case of Trip.com, I was in Vietnam yesterday, and it was so incredible to see the revival in the tourist sector. And the Vietnamese government is very open to new investment, to tourism, and the Chinese tourist is already climbing back to be the #1 most important constituents of that market.
Yeah, and hopefully they open up their purse strings a little bit more and spend more to that point. So Trip.com is one of the stocks you talked about there. I think we just showed for our viewers Tingyi and I believe Tencent. And really the only overlap between those three companies, one is an instant noodle maker, the other makes games, the other on trips, is that significant market share in their own markets. Is that a criteria that's important to you?
Absolutely, absolutely. Market share provides a moat of defense. And in the case of Tingyi, they control the instant noodle market with a 45% market share. What we like about Tingyi is it's a direct play on consumption. They target the entire market. But also they're very innovative. Every year they introduce anywhere between 10 to 20 new products. And that supports revenue and earnings growth. This year, for example, they've introduced a non-fried instant noodle product, which we're very excited about. And all of that at 15, 16 times anticipated earnings growth. So we believe that there is a possibility of earnings revision in a company like that.
What we haven't heard you mention so far, and it's sort of notable in today's context, is a big Chinese tech name, particularly given, of course, the DeepSeek rally that has driven so much of the momentum. I mean, your outlook for Chinese tech, what are you liking, or what's making you more hesitant?
Of course, so we do like Tencent, and again, for a very similar reason, it is a massive player. It has a 54% market share. In gaming, a totally dominant brand. And it's that brand and intellectual power that the government seems to be targeting at protecting, nurturing, developing. Tencent has roughly 16-17% coming from online advertising. So that would be an area that would benefit from this boost of consumption.
No BYD? No EVs? Like, how are you thinking about the industry, and if you had to pick a winner there? I'm curious.
I would like to own more, but we do manage a global portfolio.
Okay.
And we're constantly competing for ideas.
Right. So, guys, that takes me into my next question, right? Just to broaden out EM. So, do you have a internal maximum on exposure to a single market and to a single stock?
Yeah, so we target 15% at purchase, country self-imposed limitation. And we do that because we try very, very hard to diversify across regions, to provide this capacity, this ability to look for hidden gems across many different countries. It also allows us to minimize risk and volatility.
I would guess that limit, in some ways, is also forcing you out into other frontier markets that perhaps others aren't looking at as deeply. Elsewhere in Asia, Southeast Asia, outside of Vietnam, any opportunities that you're particularly liking, anywhere where you're particularly increasing your exposure at the moment?
So I would say that in Asia right now, we're most excited about China and Vietnam. But we're always competing for ideas and space in the portfolio. So recently we have added exposure to South America, particularly Brazil. This market is trading at 7 times trailing earnings. So this is truly a historical low. And we're seeing some possible changes going into next year, possible move to monetary easing, which will further stimulate the economy. We're adding in Eastern Europe. That's another area where we're finding very, very exciting opportunities, in Poland in particular. Most recently, that market has gained quite a bit of traction and attention because of the changes in Germany. Poland is a major trading partner, and we believe will be a beneficiary of this increased fiscal spending in Europe.
So what's the play in Poland?
So in Poland, we own several stocks, but we're very excited about real estate. Dom Development, for example, is the largest residential real estate company in Poland. And in addition to this sort of macro tailwind in Poland, the market is very overcrowded. Roughly a third of people live in overcrowded homes. So there's this long-term secular trend towards more homes and more demand.
I mean, it seems that the risk appetite of your fund is higher than others, let's put it that way. So my question is, how do you manage currency exposure? That's number one, because many of these markets have weak currencies, let's put it that way. And is there one emerging market or frontier market that you would not dare touch?
Good questions. So historically, we manage risks through diversification. Having a variety of country regional exposures help dramatically diminish the currency risk as a driver. That, of course, has not been as effective when the dollar has been so incredibly strong or had been strong against most currencies globally. We do think that the outlook for the domestic currencies is stronger going forward, so that could potentially provide a tailwind to returns. And are there any markets that we will not touch? Typically markets with capital controls, but they're very few in between. I would say that today our number one challenge is to invest. We have so many ideas. It's a fertile ground for stock picking, and we're constantly fighting for cash.
Yeah, there we go. Too bad the max is 100, right? You got to find room in that. Thea, it's very nice to see you. Let's talk again soon for an update there. Thea Jamison, founder, manager director at Change Global Investment. And by the way, for more on this China consumption story coming through here, we'll be getting some analysis from Standard Chartered's macro strategy team, and also coming through in the next hour, Bloomberg TV, the Shanghai Advanced Institute of Finance. You might know him, Choong. There we go, coming through on Insights with Linda Ahmed. Plenty more ahead. This is Bloomberg. Welcome back. So Hong Kong's New World Development is said to be in talks with a luxury giant, we won't give you out the name here, to open a mega store in one of its signature malls. I think we gave it away there with our graphic.
What are we withholding here, Dave?
We took away the thunder from Shirley Zhao, who is here with us, a conglomerate media reporter. Yeah, so LV. In what mall, and how big is the store? How big are we talking here?
So we learned from sources that LV is in talks with New World about opening a new store at K11 Musea, which is one of New World's most signature malls in Hong Kong. And we understand that the store could cover an area of about 40,000 square feet, which could be one of LV's biggest stores in Asia. And the store could feature elements, for example, museum and F&B and a VIP lounge. Of course, we understand that the discussions are still ongoing, even though it's at an advanced stage, and the deal could still fall apart and details could still change.
Okay. The broader context that you've reported on so brilliantly over the past few years is actually the difficulties in Hong Kong's sort of shopping and consumer market. So I suppose I want to know what kind of impact that this could potentially have for Hong Kong, and also perhaps a more opposite kind of pointed question that investors will be thinking about is, what does this mean for New World?
Right, so the expansion of Louis Vuitton could create a boost for Hong Kong's retail and Hong Kong's commercial property sector. We've written in the past that Hong Kong's commercial property sector has been suffering from plunging rents for as much as 90% in some of the core shopping areas in Hong Kong. And the expansion of luxury brands could inject some confidence into this sector. And for New World specifically, this could generate more foot traffic in K11, which is a heritage asset for the Zhang family. So K11 Museum is located on a site that the Zhang family has been owning properties since the 1970s. So it's an important asset for the Zhang family, and it's also the focus for a lot of investors on New World. So according to Bloomberg Intelligence, the arrival of Louis Vuitton to K11 could draw more foot traffic and thus raising retail rents for the group.
Okay, excellent. Really, excellent reporting there. Thank you so much for joining us, Shirley. That's Bloomberg News conglomerate and media reporter Shirley Zhao there. Now, to another story that we are watching here in Hong Kong. The billionaire, sometimes known as Asia's Warren Buffett, has died at the age of 97. Li Xiaoqi founded Henderson Land Development in 1973 and built it into one of the city's largest developers. His $23 billion fortune ranked third in Hong Kong. A statement says Lee passed away peacefully on Monday, surrounded by family. There's plenty more ahead. You've been watching The China Show. Stay with us. This is Bloomberg. Right, welcome back. You're watching The China Show, and here are some of the major political stories that we have been following this morning. Israel has launched a wave of airstrikes across the Gaza Strip on Tuesday in response to what Prime Minister Benjamin Netanyahu says is Hamas's refusal to release Israeli hostages. Gaza health officials say at least 44 Palestinians have been killed. The move shatters nearly 2 months of a shaky ceasefire that had paused 15 months of fighting. The White House says it was consulted ahead of the attacks. President Trump says Chinese leader Xi Jinping will visit Washington in the not-too-distant future without giving an exact time frame. Discussions between the two countries on trade and other issues are stuck at lower levels, with both sides deadlocked on how to proceed. Trump has said he is open to talks with China on reaching a fresh trade deal, even as he intensifies pressure on Beijing.
Right, and as you wait for that visit, we understand from state media that Chinese President Xi Jinping has visited the province of Guizhou in the southwest of the country, inspecting and really talking about, and this is according to state media. So let me just read out some of the items on the agenda there. He visited an ethnic village there in some of the prefectures, and really on the back of looking to revitalize that part of the country, which, just in terms of your geography in China, of course, is, on a GDP per capita, is really one of the poorest provinces in mainland China. So this is really on the back. This is rural revitalization efforts they're coming through there out of China. We'll leave you with a look at another group of stocks here ahead of some earnings coming through from these companies on your screens. That's it from us here. We'll see you all tomorrow.